Welcome to Forex Debunked. Today I'm going to be talking about, is Forex a get-rich-quick scheme? A lot of people out there think that you can make a lot of money overnight. Is this true? Let's explore this a little further. A high percentage of traders lose money in the long term trading foreign exchange. Why are they losing money? What is the reason behind that? A lot of this lifestyle has been sold through driving fast cars, flashy watches, and everything else. So why are they losing, and what makes the winners stand out? So let's talk stats. Over leveraging on your trading is one of the biggest contributing factors to Forex trading losses. A study that was done by the National Futures Association shows exactly that using high leverage is one of the biggest contributing factors to Forex traders losing money. As I previously explained in one of my other episodes of debunking leverage, it is super important to start with low leverage, build that confidence around your trading strategy, and get familiar with the markets. The next point that we want to move on to here is the importance of stop losses. Now, a study done by the International Journal of Economics shows statistically that traders that use stop losses had an improved performance on their foreign exchange trading. Now, if we can take something from this study, it shows that limiting our downside risk to, example, 1%, and having the upside of 2, 3, or 4% in our gain of our risk management shows that limiting our downside losses and increasing our upside potential really does improve your performance potential as a trader. So people don't like risk management. It's a very important factor to be successful in trading and get away from this whole gambling mentality of get rich quick. So using the stop losses is an important factor that we want to implement. We want to have consistency in our position sizing in the markets. So when we trade, we want to make sure that we're calculating our 1% risk per trade to ensure that we're allowing probability to pan out using maths rather than gambling. If we can maintain risk management of 1% on every single trade consistently, no matter how much we like the trade emotionally, as long as it meets your tick list of exactly why you're entering the trade, you should be consistent with putting on your exact same position size in percentage risk per trade. Now, a lot of traders don't do this because it's hard work to manually calculate your risk. I'll do another video on how to calculate your risk, but it's super important to use the exact same consistency in your position sizing. This will create a stable result. Whether that's good or bad, it will create a stable outcome for that trading strategy. If you were to risk 1% on one trade, 5% on another trade, 0.5% on another trade, you have no consistency and no clear direction whether or not your trading strategy is working for you. So build consistency around your trading plan and stick to that magic rule of 1%. So the next point here is drawdown management. Now, this is your high point to your low point in your equity growth. Your trading strategy could be perfectly fine. However, you will see losses. It is part of trading. Let's say you're risking 5% on the trade. That's a 50% drawdown. Your emotions are going to be all over the place. It's not sustainable. And statistically, we know that we could hit a 10 loss run and follow the rules exactly right. Now, in order to combat that, we want to use a risk that we would be comfortable understanding if we were to hit 20 losses in a row. So if you're comfortable potentially using 1% per trade and all of a sudden you were to have 20 losses in a row, you would know that roughly on a back-tested strategy that you have worked with, the worst case, we should hit 20 losses in a row, which would give you a 20% max drawdown to go off of. How do you feel about that from a level of comfort? Are you happy understanding that that could be the worst case, although unlikely it could happen? Will you still be able to take the exact same trade emotionally, knowing that you're following your rules to a T when you're at a 20% drawdown? If you're not, you need to lower your risk per trade to potentially even 0.5%. So that, how would you feel if I lost 10% of my account? Emotionally, would I still be able to take that trade exactly the same and let my strategy pan out for the long term? Now, when you do that, you have the risk management in line, you see where you want to be in the long term throughout your trading journey, and it allows you to focus on the incremental trades on a one-by-one basis that build up this longer term vision, allowing you to focus on your longer term outlook of the markets. What is a reasonable target for a trader to target? Well, everybody at Samuel & Co sort of targets between 2 to 6%, with the sweet spot of being 4% per month. So risking 1% per trade, they can achieve a 2 to 1, and ultimately they only need 2 trades in order to hit a 4% monthly average. This allows for individuals to be focused on the long-term vision and compound their account to grow. Utilizing proper risk management has a lot of psychological benefits. Understanding that your journey is for the long term, understanding your risk management before you place a trade really benefits your performance from a mindset aspect. Because if you understand that you could have 20 losses in a row, your psychological understanding is that that could happen to you. You're not placing a trade in the hope that you're going to win every single trade. Focusing on the long term, having risk management, percentage risk set per trade, a strict strategy of step-by-step points that you want to follow on your trading journey. Having all of these small little factors in play really benefit your psychological aspect of the markets and allow for you to understand what is the potential worst case scenario for you when you're implementing your 1% rule. You can alleviate the market stress and allow for you to actually perform as a trader, rationally making good decisions within the market rather than irrational, high-risk trades, emotions all over the place, laptops getting smashed. So make sure that you're following all these steps, because your psychological aspect of how you look at the markets emotionally is going to be one of the biggest factors with your performance. Traders that often implement risk to reward ratio are not only more emotionally stable in the markets, but also have a better long-term outlook for success in their trading journey. A common rule is for traders to utilize a 2 to 1 reward to risk. This means that ultimately I'm risking potentially £100 a trade for £200 profit. This is what we call a 2 to 1 reward to risk factor. Now, having that in line, if we can increase that positive expectancy to potentially 3 to 1, so £100 risk for a £300 gain, it actually means that we could potentially lose more trades than we win, but still gain from the markets. This is what we call tipping the edge in the trader's favor. If we can do this successfully, it means that we don't need to worry about chasing the market, because ultimately the probability and reward to risk will be in our favor in the long term. Other benefits to utilizing a positive reward to risk is also the preservation of capital. You don't have a large amount of your capital allocated to one trade where it's either make or break. And ultimately, if you did win, psychologically, you're then going to try and do that again. And again, it's going to equal to you blowing your account. Where having a positive expectancy from your trade of a 3 to 1 potential, you're going to end up being there for the long term. And ultimately, you should be more concerned about preserving capital first before growing your capital within the foreign exchange market. Another benefit of reward to risk is the fact that you don't need as many trades winning to be profitable. What this does is it has a massive psychological benefit on your performance, because you understand that you may only need 3 or 4 wins out of 10 trades to be profitable in the long term. This allows you to keep your emotions parked to one side and focus again on your trading strategy. Also, another factor on this is the reduced pressure to predict the market trend correctly. Understanding that you only need to be right 40% of the time with a 3 to 1 reward to risk to actually profit from the markets just shows you the benefits of having that positive expectancy from your reward to risk. This again alleviates more mental stress on your trading and allows you to get over those learning hiccups in the markets. If you start applying all of these rules that we've discussed in this video, you'll be surprised how your performance as a trader can increase and start moving in the right direction. Remember, first, preserving your capital is key, and then you move into the growth stage. Once you're at that stage, it's all about risk management, making sure you're using low leverage on your account and keeping your emotions at bay with low leverage, risk management, reward to risk, and all the other points that we've discussed. So guys, I hope you've enjoyed this video of me debunking Forex as a get-rich-quick scheme and how you can improve as a trader. If you've enjoyed this video, hit the like, hit the subscribe button, and I'll see you in the next video.